Yeah, so this is a session we are trying to provide you, which will help you to take your own decisions, and if you're able to master the Excel sheet, which we'll be training over a period of the sessions and next few days, then you can have complete control. You don't need to seek advice of any other people as far as the trend is concerned, or what actions you can take. So this initial part of the session will take you ultimately towards the Excel sheet. So we will just try to give a groundwork what exactly we are doing in an Excel sheet. So you have the knowledge, and most of the technical parameters and factors are already taken care into the Excel sheet. So what are the things which we are looking at in the Excel sheet, and what are the we will be looking to it. So for this you don't need to know technical process, but you can just understand what I am trying to say.
Okay.
Okay, so how to trade effectively in futures with technicals. Let's see what it is. Now we want to define a trade for ourselves. We want to define a trade for ourselves. Okay, so what are the things which we will be looking at? First is trend. Second is volumes. Trend, as you can see on the screen.
Yeah.
Are you able
Trend.
to see the screen? Trend. So second is volumes, third is relative strength, and then we have the levels. This is basically more of use to cash markets, but now once we add open interest, we go to the futures markets. So in futures markets, what we will be looking at is open interest and volume, relative strength, levels. Okay, levels are the last thing to be looked at after finding the trend and deciding and shortlisting the stock future which we will be looking at to trade finally. So before that, levels are immaterial. First is the scanning process. What is the scanning which we are going to do? Good. So let's take this briefly. What is trend, open interest, step by step.
Okay.
So what is a trend? So what we are doing is in the trend analysis is I have split it into two parts. What I feel the trend is can be divided into two parts. Subjective way of analysis, and another is the objective way of analysis. Subjective is would be differ from person to person, analyst, and mindset to mindset of a different person. So that goes into subjective. Objective becomes more statistical and mathematical in nature. So your objective is to mechanically define what is an uptrend and what is a downtrend. The concept of trend is absolutely essential to the technical analysis approach to the market. Okay. All tools used by chartists, technical analysis like support, resistance, price, moving average, trend line, etc. have sole purpose to identify a trend. So you must have heard about a lot of what is the support, what is the levels. Okay, generally in the media channels you generally hear what is the support, what are the levels. There talks and discussion till a level point. So very few actually are in a position to interact more further than that. They will not be talking of any other patterns. They will not be talking about what is the trend line, what is the moving average. They will take क्या level है, what is the level, what is the uptrend, what is the downtrend, what levels you are expecting to go, what levels. So again that is very subjective because support and resistance changes from person to person, analyst to analyst, and it will differ from the trader's mindset to mindset. So somebody might for some be a support, but for other guy it may not immaterial that support because his view is for market is going to fall down. So he will not give importance to the support levels. So these are all basically subjective ways of looking at markets. Market moves are characterized by a series of zigzags moves. Zigzag moves is like a staircase ladder, how it goes up, with a step we go up, and reverse way on a down, on reverse way on a down the ladder. So market moves up and down, so it is never a straight line basically, whether it is any kind of time frame of the analysis. So it's up and down, and down, and up, down, as the case may be. Zigzag resembles series of successive waves, like is waves what we would say, like suppose the price will move from 10 rupees to 50 rupees and then comes down to 25 rupees. So 10 to 50 is a movement, a move, which is called as a wave. Okay?
Okay.
Say 50 rupees to 25 rupees comes down and after that starts going to 75 rupees. So 50 to 25 is a wave. So it is a move, it is a movement, it is a range, it is a top, bottom, high, low range. So zigzag resembles a series of, it will mark to you a series of ups and downs and it will show you what are the peaks and the tops, peaks and tops and troughs. Troughs means bottoms or valleys. Valleys means how a valley is there of a mountain, the lowest point. Okay. The same way, troughs and valleys. Trough is something or a valley. Between the two peaks of the mountain there is a valley. Okay, how that is there, or the bottom of the lowest points of the mountains is the valley point, basically. So direction of these peaks and troughs constitute market trends, like up, down, up, down. We'll have various types of market trends. So in subjective analysis, I said to you, it is a high top, higher bottom formation, which is called as an uptrend. So generally when we are talking and in a very general way in any of the channels or personal talks, when we say it's a market is an uptrend, so broadly we are looking at is the market is making higher bottom. Higher bottom means what? If 10 rupees is the bottom, market goes to 50 rupees, comes to 5 rupees and goes to 60 rupees. So 25 rupees is a higher bottom in relation to 10 rupees. That is called as a higher bottom. So then afterwards from 75 comes to say about 50 rupees and goes to 100 rupees again. So 65 becomes another higher bottom in relation to 25. So what we are doing is that every peak is higher than its earlier peak and every bottom is higher than its earlier bottom. Okay, so that is called as a higher top, higher bottom formation. Okay, similarly vice versa, it becomes at the peak. Then the top is 100 rupees and it falls down to 80 rupees, then pulls back to about 90 rupees and then again falls down to below 80, so 75 rupees. So 90 becomes a lower top against the top of 100. Okay, and the bottoms are lower, so that becomes opposite of lower top. Now sideways and multiple tops and bottom. When we say the price movement is 100 rupees and 80 rupees, and market is fluctuating between 100 and 80, there will be many tops and many bottoms within that band. So therefore it is a sideways because the extreme points are not getting exceeded in subsequently. So for example 80 and 100, market is fluctuating between for next 2 months. So that means it is moving sideways, or even for 15 days for that matter, or market is moving sideways. And within that you will have the small tops, like from 100 it will come to 95, then it go to 98, then it fall to 90, then it go to 90, or then it goes back to 99 again, then it falls. So it will just making small tops and bottoms. So that is creating multiple tops and bottoms. Support and resistance. Support means what? Support means generally the lowest points. Supports can be looked at as a different ways by different people depending on what they are looking at. Support basically in a general term would say that buying is likely to emerge as the prices are at lower end of the movement. And from that points, buying could emerge because market has fallen down. So say the earlier bottom was about 90 rupees and market from 100 is coming and testing the support, we say that support of 90. So because buying is likely to emerge because last time market had moved up from 90 rupees to 100 rupees. So once again if 90 rupees is getting tested, then we are likely to the buying to emerge around 90. So till 90 is not violated. So what happens? That becomes the support. What is resistance? Resistance is something, suppose market has made a peak of 100. Okay, and market falls down to 90 and is coming back around 100. So market will get resistance because last time market had fallen from 100 rupees down to 80 rupees. Now it is once again coming near 100 rupees. So market is going to get a resistance around the same. That means selling or profit booking on the long side may be seen during that. Okay.
Yeah.
So that is support and resistance. Support and resistance, mostly it will be related, buying is likely to emerge, that's why we expect the support to be witnessed so that prices might react or move up from that point. Resistance exactly opposite. Selling or profit booking is likely to occur on long positions. A point where it may not be able to cross that because selling is going to be more dominant. So that is why it is called as a resistance. Prices are getting resisted. Resistance means like opposite direction, pressure of opposite direction. Buy positions are trying to create a prices upwards. Sell positions are trying to create a price downward. So around 100 there will be selling might be more dominant. So that is why we expect 100 rupees to offer resistance, because last time 100 was not crossed and failed to sustain around the same. So we expect resistance to be witnessed around the same, so we call as resistance. Where selling is likely to be seen or profit booking. Then there are various types of analysis generally done is the trend lines. Trend lines is something like, suppose we say that the bottom was 10 rupees and the higher bottom was 25 rupees. So what we are doing is that geometry. In geometry we have done that we are just joining the 2 points with a ruler.
Yeah.
In the school.
Yeah.
So 2 points we are joining to make a line. So it is called as a trend line. So 25 higher bottom was 50. Then we are joining 25 and 50. That makes a trend line. So as long as the prices remain above the trend line, trend is likely to remain up irrespective of intraday or extreme near-term volatilities. Prices as long as are above the trend line, trend is likely to remain up, and vice versa. If the trend line is taken from 100 rupees and 95 rupees, which are the top and lower top, and you draw a trend line with a ruler, then we see till the prices are below that, we see trend to remain down till the trend line is not violated in future time, because the trend extended down, and whenever every day's prices are plotted, as long as the prices or price bar of candlesticks remain below the trend line, trend is likely to remain down. Trend lines and trend lines are pretty similar. They are more like same concepts. Channel drive is something, and opposite, suppose if you draw a trend line from 100 to 90 rupees, falling down trend line, a sloping downward trend line, and the bottom was 80 rupees. So we take parallel exactly to that trend line, become a parallel trend line. I will show you in next clippings what is that we are talking. So that becomes a channel. It's a ruler which has 2 edges on the right side and on the left side, and that will create a channel. Okay, so we create a channel where the prices will deviate or fluctuate between that channel, and the direction of the channel is down. Then we expect prices to remain down with volatility within that channel. So it will slow down on a rising downward channel. The channel rise or channel fall. So what is the height of higher bottom? I just said some time back. This is height of higher bottom formation. Okay.
Yeah. May you please explain the fan line?
Yeah, I'll show you in the chart what is that when it comes, because without just by words I cannot express. These things I can tell you by words, that was little easy to. Okay, this is height of higher bottom formation.
Yeah.
This is lower top lower bottom formation.
This lower bottom.
This is in a band, and markets are not exceeding the earlier peaks and earlier bottoms are within the band. Very well up and down cycles, but probably it is not making new highs or new lows from the recent areas.
Yeah.
And you can see over here what is the channel. When I am drawing a channel, parallel channels are drawn, which will give me a trend that the direction of the prices are up. As long as the channels are remains intact, rising or falling, prices are expected to, like suppose if you are looking at this where the mouse is there, when you are looking at this particular channel, this is, and the parallel to this is this. You expect this swing, which is a broader swing, to move the prices higher. By making, within that there is also a small channel, which is within the channel. So you expect that the channel, as long as the prices behave or move between this zone, we expect it to be a channel rise in this case. In the other case where it is a falling, downward falling prices, the trend lines and channels are very similar. The only thing we have an parallel to it. So in this case you have a small downward channel over here. So you have a channel fall. The moment the channel gets exceeded, we know that the direction of the price movement is likely to move higher. Now these drawing channels and trend lines come with practice, because many people draw various kinds of trend lines, taking any points for that matter, which one can feel comfortable or visibly on the chart. Okay, the fan lines, just to show you, is something is slightly more advanced. It is to take up the story on the chart. Are you able to see?
Yeah, I can see.
Hello? You are
Yeah,
still
I
there?
can see.
This. Okay. In the software, there is a thing called fan line. The fan line, what it will do is that I take a bottom and take a top, and it will draw three kinds of, with some degrees of the angle. And moment this fan line is broken, then your trend is down. In current scenario, we could take it over here in this chart, take it over here on the lower side, and we could say that trend is still up, as long as they are hanging above these lines. Time will offer support. So there are something slightly on a advanced level, but just for the timing, you can understand there are various techniques which are available, and we not need to know right now all that. Just to understanding purpose, trend lines are enough. Then we come on to the objective trend analysis, objective trend line. Objective would be more to do with the statistical, like a moving average. Moving average is a statistical mathematical tool where you are saying that average which is there of last 10-day prices of the closings. Then we say divided by 10, add sum it and divide it by 10, then you get an average point of the day. So average point for the day of last 10 days. If we are considering a 10-day moving average, every day the same point is plotted and it is overlaid on the price chart. So moving average is something that also I will show you in the clipping. Moving average are one of the important, popular and easy to use tool available for technical analysis. They smoothen the data series and make it easier to spot trends, something that is especially helpful to the volatile market. This is so easy because it is just a mechanical that we decide that if prices are above the 10-day moving average and the trend is up and down. So generally there are various kinds of averages we are taking there in the analysis. And each of the techniques are there, prices are there, simple moving average, exponential moving average, various kinds of averages. We are just talking at a simple level, simple moving average. Price above the average is uptrend and downtrend. You can calculate the averages based on open, various things. There are multiple combinations in that. So we are not going to detail, just to understanding what is the trend we are talking about it right now. So it's something like 10 plus 12 plus 13 is 60, then we'll say divided by 12. Okay?
Okay.
Now I plotted the average on a chart. Now this is a candlestick chart, for example, and in that you can see a red color average and a blue color average. So if prices remain below the average, then we assume that there is a downtrend. If prices are above the average, they are uptrend. So we don't need to ask anybody what is a trend or what is uptrend or downtrend. Okay. All these things are available on many of the websites right now for free chartings. Where you can use the end of the day charts, UD chart, that is a daily chart, and you can overlay and identify yourself that is an uptrend downtrend. This will not tell you what
ICICI
will not tell you is whether the most of the sites are there having nowadays. This is a basic requirement of many of the sites, and one has to be there, whether people know it or don't know it to use, but it has to be there. Okay.
Excuse me,
Now what happens? This is very easy to. Pardon?
just a minute. Just a minute. Uh,
Uh,
Actually, I am asking what should be the moving average, these two values of moving averages.
uh. See, values are moving average as something which is related to risk factor. Okay. So if you are a very extreme near-term trader, you can live with a very longer average, because if you take a larger averages, they will be far away from the prices, and the risk will be higher. So if you are trading on a very near-term to short-term basis, based on the daily chart, then your averages can be anything between 5, 8 or 13, not more than that.
Which one?
And
5?
the 5, 8, 10, 13, either of the ones, depending on the risk appetite. Somebody who cannot take a very high risk, then 5. But this is only to identify an uptrend and downtrend depending on our requirements. So if you are taking a very longer average like 30-day or 50-day, then moment I say 5-day, I am looking which is lasting for maximum 5 days. Only in a very steep trends, market will just remain above 5 days, because 5 days is a very short average, and sustaining above the 5-day average for a long time is very difficult. Say case it goes with 8, 10. So when I am saying 10, when I am saying 5, probably you are looking at a 1 week kind of a, you are looking at 8 also something like 1 week scenario, 10 also like a 1 week scenario, or maybe 1.5 week scenario. When I am saying 30 days, then mostly you are looking at 1 year, 1 month. Okay, so 1 month kind of a thing. So if the moment you take a larger average, you are taking a larger risk, because in a stronger uptrends, the average are going to be far away from the actual prices, because they are a summation of average. So therefore, the deviations which are there, the risk can be higher if you enter late into market. So always whenever there is a crossing of prices above the average, that is more or less your entry point, because the risk is more or less lesser than the trend which is already established some time back, and the prices are going higher. So you cannot take a positional call if you are looking at a 5-day mature trend. At the most you can take an intraday call or a 1 day call kind of a thing, as that we will be doing when we are doing an actual exercise. So what we are doing is that we are trying to define each and every column right now of the Excel sheet which we will be using to an extent. In some parameters, we don't it completely. What I am telling you in a summary, you need to understand what is it, because going in depth of each and everything is like a 3 to 4 months course. Okay, so because if you start covering each and every aspect in detail, then it will take 3 to 4 months to complete the course. Yes, people are doing it in a crash course, but that does not help for the person who is listening to it. Okay, because there are a lot of negative points, positive points about various techniques. So one has to understand the different aspects of the technique, when they fail, when they don't fail, when they perform the best. So when you start using them, you need to know and understand that. So it is not just like a crash course that you are looking at certain average. Average itself might sound a very simple thing like this, but I can talk for 2 hours on a moving average. Just on moving average itself. More than 2 hours for that matter also. Because we'll have to look at it. All that I am summarizing into an Excel sheet, and I am just telling you at the end of the session that what you are supposed to do. It is like a Excel sheet created by a Microsoft. We don't need to understand why Microsoft and how the Excel sheet was programmed and was made. Okay, we need to know and understand how we are going to use it. So what I am doing is right now giving an orientation towards the Excel sheet, so that what we are going to, how we are looking at the things, that you will come to know. Okay, so in this case, when we are talking of average, we will be using moving as a very important parameter to define a trend. We are not going to leave it very subjectively for somebody who doesn't know technical analysis and still wants to know a trend. For him, we are going to keep it only on the objective base. Okay, because otherwise something you cannot describe an average, describe a trend, because when somebody would say that a major uptrend, somebody will say, no, no, I feel market will come down. Because both people are talking in a different thought process and terminologies. Because somebody is looking at a 2 to 3 months market, and somebody is looking at only a 10 days market or a 5 days market. So both thought process are correct, maybe correct in their own ways and own place. But if you're listening to two people, then you will not know why, which to listen and which to do, unless you personally interact with them and try to what they are trying to say. Otherwise, it is impossible. So therefore, when you are listening in the media, a lot of analysts coming and talking about market are going up or down, everybody has their own thought process and ways of looking at market. So therefore, there is a difference of opinion about different analysts who are speaking. Therefore, listeners sometimes get an issue because one person says buy, another person says sell, and whatever. So this will never, a listener who is not aware about what they are saying will never come to know what they are talking about. Because there can be differences. Therefore, there is always a debate that everybody says different. We don't know which to follow, whom to follow, what to follow. So sometimes it is just, we can say a trend is up and follow with a stop loss. When we say follow with a stop loss, some people will give you a very tight stop loss, and that can be just be for an intraday or 1 day. Some people might give you a loose stop loss. They might give a loose stop loss slightly with an intention that they want to take a slightly broader time frame of the trend. So even the stop loss differences will happen because the person who is looking at the market and the trends will think at the market in a different. So objectivizing this concept of trend is essential if you are not knowing anything about markets and uptrend and downtrend. So we want to put this thing completely in object. So our first indication comes from trend. It is up or down based on mechanical setup. Okay. Next important factor which we are looking at is strength. We want to see whether the stock performance on actual stock performance in the market. So we want to see if you are looking at an uptrend, just uptrend is not enough for you to select a stock. So uptrend is one parameter where you are going to define or select a process of shortlisting the stock futures. So strength alone is not enough. The second important factor is the relative strength. So saying about relative strength, we are trying to say that how it is performing, how a stock future is performing against the benchmark Nifty. So whether you want to know whether Nifty, the stock is outperforming the Nifty, underperforming the Nifty, we would like to know that. So when we are doing this, we would like to say that basic stock future price, that is say Reliance divided by Nifty. So you get a ratio. What is the meaning of this ratio? Actually, what is the meaning of the strength? Strength can be laid down in 6 different types, different types. So it is a ratio of Reliance divided by Nifty, for example. If Reliance strength will be added in a stock and when a strength will be lost in a stock, that one needs to understand. So when we are talking about strength, we have to define a time frame parameter also. You can define, there are various, again, relative strength is a concept used by various analysts in various different ways, depending on their own requirement and what they are looking towards the market. Some people define on a running basis that what we will be doing, we will be defining a strength for 7 trading days in relation to Nifty. Some people will put strength in relation to the tops and bottoms. Say market made a bottom 2 days back. Okay.
Okay.
Hello. Yeah. Market made a bottom 2 days back. So they are to identify which of the stocks which have moved in last 3 days. Again, they made on 8th of August. So which are the stocks above it and which are the stocks below the prices of 8th August. So because 8th August was the bottom. So this will be for extreme near term, short term. Somebody would like to say that which are the prices when the market made a top 2 months back, which are the stocks which are moving above the prices of say June, some date of June when the market was at the high, 20,400, around 400. Hello? Hello? Hello?
Hello.
Are you here? You are there, right?
Yeah. Last few seconds,
Okay.
the sounds were turned off.
Because of the internet
I
conditions
think it is that
fluctuating.
it is the problem from internet, I think.
Okay, I will repeat again. What we are trying to say about relative strength is that we are saying Reliance divided by Nifty. Okay, so we need to understand whether your stock is outperforming the Nifty or not in order to know whether the trend is firm. Some people would do it, we will do it on a running basis for 7 days. Okay, we're
Okay.
comparing running 7 days. But there are many people who will do it, say 8th August was the bottom of last couple of days, last week's bottom from market. We would like to compare stock prices with the bottom of 8th and see how they have gone up or down in relation to the prices of 8th of August. Some people will say the market made a peak of in 20,400. That time they will compare the prices today and that day prices and see whether the stocks are up, have fallen by 500 points, for example. So we will say about 6,000 that time. Okay, and today Nifty is about 5,800. So Nifty, what's the fall of Nifty? And they will see Tata Steel, TCS. TCS was what price on and compare today's TCS price. So they will see what TCS has fallen in relation to that day prices or gained. So if they are gained, then we will say that TCS is stronger in relation to Nifty because Nifty is down. That is one way of looking at it. There are various ways I will just briefly describe in next few clippings how you can identify strength. What we are doing is going to take a running 7 days of strength of stock future divided by the benchmark index. So Reliance divided by NCC divided by Nifty. We get a mathematical ratio. And that ratio, we are using an indicator like RSI, and we are putting that formula into an RSI formula. So it is not a completely an RSI because in normal RSI we take closing prices. And over here we are not taking closing prices. Some people are using rate of change also. Basically what we are trying to do is trying to scale between 0 and 100. When stock price is divided by Nifty or benchmark index is a figure. It might be in decimals, it might be in one. So that has no relevance actually unless you plot it and see. So if Reliance and divided by Nifty, if the chart is going up of this ratio, then we will say visibly on one-to-one basis that Reliance is doing better than Nifty. If that chart is falling, then we'll say that Nifty is doing better than Reliance.
Reliance. Yeah.
Okay, so this is a basic vision. That also clipping I will show you. So relative strength is basically trying to know whether the comparison to the benchmark. But what we are adding further over here is that our bunch of stock futures, including 1 month, 2 month, and 3 month, third month, we are taking all into account actively traded, and each will have a ratio assigned to it. Each will have a rating assigned to it. Okay, each will have a figure assigned to it. So, and not only, and they are then sorted on ascending and descending order into separate sheets in when we go into look at the sheets. So one, in a downtrend will be sorting on the strength in an ascending order. In an uptrend, we will be sorting on the descending order. And we use both the sheets separately, doing the same logic in identifying a buy trades and a sell trades. Okay?
Okay.
So I will show you how. So there are, I was saying, various ways to be measured by relative comparative strength. What is relative comparative strength? Is basically Nifty divided by Reliance. Reliance divided by Nifty is relative comparative strength. Relative performance is also same, price relative is also same. There are various ways of looking into this ratio and then assigning it into an oscillator or an indicator or putting it in a chart format and rating into 0 to 100 scale. So basically we are comparing two securities, how they behave and perform against each other. Maybe a lot of fund managers, what they will do is that they will take the indices of all the countries of the world, FTSE, DAX, South Korea, KOSPI, Singapore, Australian index, Indian index, all the indices of the world, and they could rate it into strength. So they will know which country is performing better in the world market. So as a very macro analysis is concerned, very macro analysis, they also will do some kind of relative strength that if Dow Jones and Europe or American Euro market are having better strength than the Indian market, then the money flow will not come in India. It will have to be go abroad, because money or this money is more opportunistic in nature. It will go wherever there is an opportunity for returns to do pretty well. If some countries having a weaker strength, then you will always find that there is no that index or no inflow in the markets of FIS. So this is just to give you a broad horizon. You also can do a comparison between the sector. Like if I am looking at the sector like a two-wheeler sector. So if I am looking at Bajaj Auto and Hero Honda, if I want to know out of the two which I want to select, you can do this exercise as you go into advanced level. For the timing, you can just understand, because each of these topics take a lot of time in session to understand from the utility angle. Right now, just understand the logic and what I'm trying to say. So if I want to select Hero Honda and Tata Motors, for that matter, sorry, Hero Honda and Bajaj Auto, then I will put the Hero Honda divided by Bajaj Auto, Nifty. Just to want to see what is happening. If Bajaj Auto chart, if this ratio is going up, is supporting Bajaj Auto. Now, or vice versa. Now, what is the strength? When a strength will increase? Number one, if we are talking about Reliance divided by Nifty, number one, Reliance strength will increase if Reliance moves faster than Nifty. So there will be an increase in strength for Reliance. Reliance yesterday 1% and Nifty moved only by 1%. That means Reliance has moved faster than Nifty, because it has gained 3%. So the strength in Reliance is more than the Nifty. Correct?
Okay.
Hello? Huh?
Yeah.
Okay. So
Okay.
this is only for one day. Okay, because this is only for one day. So in the same exercise, in the formula, it will be done for 7 trading days. And see how it is behaving. Because one day might be a spiky, 2 days might be spiky. So we are trying to even out in 7 days. We don't want to take a very long 10, 15, 20 also, because our scope is for extreme near-term trading, not a very longer-term strength. Therefore, we are taking only 7 trading days. So 1 week, that is 5 trading days plus 2 from the earlier. So we want to even out. We don't want to take a very long, say 20 days, because the focus over there is not for a longer term in this kind of strength. Okay, our each and every product which I am making has a lot of importance. In a series of products on my website, there is a lot of importance to this relative strength in my products. I am using daily levels, weekly levels, monthly, quarterly levels, yearly levels. Each are having a priority importance for strength. Trends might be good, trend might be uptrend, might be there, but if they are having a relatively weaker trend, then we would not like to have that performance, because I want to an outperforming stock. Okay, sometimes it may happen that some might have moved by 50% in absolute terms in a defined period. But the stock might have just, the other index stock might have moved by 51% or 52%, and one guy is done by 50%. So then still it may not show performance for the one. In terms of absolute, it might be, say, from 50 rupees to 100 rupees. It might have done. But somebody at a higher level, with a higher arithmetic skills, might have moved from 500 rupees to about 700 rupees. It might just show a better, because we are going to take into account each and every day. We are not just taking one day. A spike can be a one day, but it is like we are trying to average it out with the formula and make it to 100 scale, which will define higher the value assigned to the stock, higher the strength in a defined period. When I am saying, okay, an X stock is having a relative strength of 60, the meaning of this is that in last 7 trading days, Reliance is outperformed Nifty by 60% of the time. Whereas that is the meaning of it. When you are saying 70%, which means that Reliance is outperformed 70% of the time Nifty. Okay, so now let's see when the strength will be gained.
What I
Strength.
Okay, what I understand, that is, if a specific time Nifty's trend, if we treat the Nifty's trend is 100%, then Reliance performed 60% according to the Nifty's performance. Am I right?
No, if Nifty past 7 trading days, it has outperformed Nifty 60% of the time. And 80% of the time it is underperformed in 7 trading days. You can say out of 7 days, it might have done 5 days it is doing better, or 4 days it is doing better than the Nifty.
Okay.
Whether it is doing better most of the time, not one day better is not there, 7 days on an average.
Okay.
So now what is the gain of strength? When a strength will be gained, when I said that the Reliance moves faster than the Nifty, then there is a gain in strength. Number 2, when Reliance is very steady, it is not falling, but Nifty is falling, then relative strength for Reliance is gained. So there is an increase in strength, especially Tata Motors. If you take the last few days, Reliance is very steady, whereas Nifty had fallen down. So Tata Motors has gained strength in last few days in compared to Nifty.
Yeah.
So if stock is steady and the benchmark is falling faster, then the stock is gaining strength positively.
Yeah.
Third, if Reliance is falling and Nifty is also falling, and Nifty is falling faster than Reliance, then Reliance will gain strength because it is falling slowly.
Yeah.
So these are 3 cases where a strength will be gained by the stock future. Opposite will be the case in case of losing strength. When Reliance falls, then Nifty, then Reliance will lose strength. If Nifty is steady and Reliance is falling, Reliance will lose strength.
Yeah.
Okay. So exactly opposite to what we are saying. If Reliance is steady and Nifty is gone up, then Reliance is losing strength. Now, why the prices remain up or down? As we know, basic rule of law of sales, and demand is there, prices demand, supply is there, prices go down. Okay. Correct? So from where the demand and supply comes? Demand and supply comes from the people, right from small retail investor to high net worth individual, and who creates demand and supply by looking at various news flows, events, fundamental, psychological, political, economic measures, government policy decisions, all world events, world news, what US does, what Europe does, everything. So who are a participant of the market, they are all looking at various news flows happening, fundamental result announcement, quarterly result, all that stuff is analyzed by everybody who is participating in a market by various ways, right from small retail investor to a high net worth individual mutual fund, everybody. So all are independent, whether somebody is a follower of somebody, whatever. Somewhere where the news is good and people are seeking directions and actions to take a buy call or a sell call. So moment they take a buy or a sell call, demand and supply will create a balance to create the prices up or down. Okay, so if supply is more, then there is a negative news and the price will keep falling. So we are depending on market to decide. Market is a net consensus of what is happening around. Market is supreme, price is king, price is supreme. No analyst, no fund manager, nobody is supreme. Price is supreme. Price gives a sense of direction. It depends on what sense of direction you are seeking at, whether it is a trading, whether it is long term, or it is short term. But most of the time, when we are watching the market, we never look at longer term technical analysis from a very longer term angle. It is looked only at a not as a long term. You can still do investment based on long term analysis, on technical analysis. The major disadvantage about technical analysis of the subject is that it does not offer psychological comfort. Psychological comfort means, what I am saying is that it does not reason out why a rise is there or why a fall is there. If you ask me why it is going up, I say I don't know. My trend is up, it is above it. I am following my price is up, so I expect the price to remain higher. In the same case, if you ask for a fundamental guy or any other macro, they will say, okay, because RBI has done this, then the price are up, because IIP data is there, then prices will go up or down. Infosys results bad, and so many good results and bad results came and went for the Infosys. In last 6 quarters, what happened is that today Infosys, in spite of all so many negative news coming in last 6 quarters, Infosys is back about 3,000. What happened when the market fell to 2,000, Infosys fell to 2,000? So, there was selling, no doubt there was selling, because somebody is selling because he doesn't want to be in the stock. But in a longer term scenario, what happened ultimately is that these were there in the Infosys, it proved to be an opportunity for longer term news. So what matters is 3 month results. What does not matter is this guidance and all that stuff. If price is supreme, price is going to lead you, because the most intelligent people who are there in the market, they are creating demand and supply, and they are dominating the price behavior at this point in Infosys. They might have accumulated in a bad way. There would be signals of buying on technicals at lower levels, but the fear of losing prevents many people from getting into the weak market conditions. Or when the markets were weak, they had given indications of buy also, but nobody wanted to buy, because the news flows were so dominant for people to really think of Infosys as an opportunity to buy. So what I am saying is, this price is supreme, price is king, price will make consensus of what is happening around. Price is a leading indicator to your known and unknown fundamentals. Okay. So price, that is why as technical analysts we are more concerned with price. The only negative point about it is that it will not reason out to you why there is a buy signal. So what happens, people who are in the habit of getting reasons to buy does not provide comfort to them. So they will say, I don't know technicals, or I don't understand, or whatever. They will, okay, your technical is saying, so we'll buy say 10 shares. But the same of Infosys. But if the same, when the price comes to 3,000, people are willing to buy 500 shares, 200 shares, 50 shares. Because there was psychological comfort. Now, because Infosys something has done good in last quarter, I don't know what good it did, but something good it comes, so it is with gap up opening. So ultimately what happens is that, which was before this news came, already a few days back. So those who caught trend in the business of making money, so they got the money. So what I'm highlighting these points is that price is a leading indicator and price decides everything. Over a period of time, you will know price will be right most of the time. So when we are taking a ratio of stock divided by Nifty, we are trying to see price performance because we believe that performance is coming. There has to be something good in the company or in the fundamentals of the company for that matter. Some good development that might happen and vice versa. Okay, believe that price is king, so we don't want to think about it, what is good and what is bad. So price is going to take us in the right direction. What matters is risk management, what matters is money management, what matters is observing stop loss as per your needs, as per your requirement, as per your outlook, as per your strategy to trade in the market or invest in the market. If my objective investments, my stop losses will be wide. If my stop losses will be wide, my volumes have to be lower so that my risk remains steady. I don't lose much. So what matters is the risk management and money management ultimately. Things are going to be wrong and right. People are in Infosys when the results were down had discounted Infosys and not interested in Infosys. But still Infosys is back from 2000 to 3000. So many ways, take ITC, in last 25 or 30 years, so many times government has put so many taxes, so many things happen on ITC in last 20 years. What happened to ITC? Today ITC is at the historical peak. So it does not make a difference whether government is what is doing at what particular point of time. What matters, if the prices are up, there has to be inherently something which is good happening in the company. Yes, on a micro basis, sometimes you might find to be spiky in nature because of the volatilities. But if a longer term establishment of the trend has already happened, what happens to Dow Jones? In 100-year Dow Jones chart, Dow Jones is up by 45 degrees. There have been two world wars, and 3 great depressions happened in various time frames in last century. But still, Dow Jones is up. It doesn't make a difference. Whatever people will come and now they are in big trouble and all that stuff. What will happen? That they might fall also from here. What difference will it make? So why bother about who is doing what? Yeah, what is your point? You follow your analysis and do your price analysis. It's more than enough. Do fundamentally is just a cup of tea, get psychological comfort, and be in the trade. Okay. So for us as a technical analyst, this is the mouth of a technical analyst. So obviously I will speak in this way. But this is the hard fact. One cannot deny that if world markets have gone up, in spite of Europe has gone up, FTSE is almost nearly new high. DAX is very near to the new high. So much of European crisis and all that. Yes, there are reasons. They have announced a lot of packages and this and to try to stabilize their economies, respective whatever. But bottom line is they are up. And still people are cribbing about US market not in good shape. Still somebody will come and talk that US market is in good shape. Somebody will come and talk US market not in good shape. Somebody will come and say Europe is not doing well. What matters, we are down. We are underperforming, bottom line is that. And money flow is not happening at all for the time being comparatively right now. So price is king, we have to follow prices. Directions of price are king because price is going to take care of a lot of these things in the factors. So we say price discounts everything. It can be a natural calamity. Say Japan fell sharply because of the so many earthquakes happened. What happened today? Nikkei is up from the earthquake price and now Nikkei is up. So it does not every time rule out. When taking a snapshot within that zone, we are in that zone, we will feel okay, there is a crisis. But on a macro and aggregate level, on a very bigger picture, it's like an Earth. When you are seeing from the NASA photograph that Earth is round, we cannot see Earth is round because we are inside over there. Okay, so when you are taking a picture, standing on a tall building and looking down, you know the entire area how it is looking. But when I come on the first floor of a building, I will not only see what is there I can see from the first floor. So my view is small. When I am taking a top view, my view is a macro view. The same thing happens in technical analysis also. When you are looking at a chart, the bigger horizon charts, your view is macro. When I am looking at a daily chart, view is micro. When I am looking at an intraday chart, my still view is very macro. People will trade for macro and ask for macro. People will invest for macro and then come and ask for. That will not serve purpose for anyone who is asking question and somebody who is answering question also. Okay, because there are many times people buy and they say now what is your, how does it matter here? It doesn't make a difference to you because you have bought in the wrong area and your price is going. How do you seek advice? But in this answer we show we cannot answer that way. But we have to whatever is we can see we have to answer. So it might be beneficial for some people. It may not be beneficial for some people. The way we answer or anybody answers for that matter. So price is supreme, price is king, and price is relatively. So therefore, these indicators like strength, when it is performing on a daily basis, or a weekly chart basis, monthly chart basis, longer term quarterly basis, and if you notice on the product which you have subscribed, you see, open the file and see Dr. Reddy, 3 stocks which are in hold long position. There is a column called relative strength. So that in that monthly chart we are looking at 12 months of revenue, whether it is performing last 12 months against the benchmark Nifty and comparing it with the entire peer lot of market capitalization of 2000 crores, which is approximately around 400 stocks. So we are looking at a buy signal coming in the scanning process of 400 stocks, which are the new buy signals coming, and out of the new buy signals, which are having a good relative strength, and then I am giving it subjectivity with the chart observations and looking at okay, it's good. So that entire, the product is given to you, but there is a lot of scanning automatically happening on the behalf. So strength is an important parameter. We will look for strengths which are above 50 for buying. Under 50 we are not interested for buying. Even if they might perform in next few days. Okay, so strength will tell you if the stock is performing or not performing, not only against the Nifty, but against the benchmark or against the peer group of about 200 futures which we are having. So it is sorted on ascending and descending order of the. These softwares are available. Some people not directly but indirectly they are available in some various softwares. Now this is a chart which I was talking about earlier. This is a old example chart, but the first chart on the left hand side over here, if you can see over here where my mouse is, I'm turning my mouse. This is ACC divided by Sensex chart. If this chart is a ratio of ACC divided by Sensex, and if this is a chart of the ratio, you can see over a period of time, and gradually you can see there has been an ascent in the prices of this ratio. It's a ratio chart of ACC and Sensex. If ACC is going up, most of the time is doing better than the Sensex. In this, it's a very chart, but during that phase, it did better than the Sensex. ACC it's better to be in ACC than in Sensex. So same case when large international funds actually look at markets, they look at something similar. When they are looking at strength as where it is coming. They are comparing Dow Jones with Indian market index, Sensex or Nifty. They will find their index going up comparatively. Then, so obviously they would say that it is not better to be in India, it is better to be in the US. So this is a ratio chart on the left hand side over here. In this page where my mouse is scrolling. The right hand side is actually ACC chart and the strength chart. If ACC is going faster, then obviously this chart will go faster. If ACC is not going faster, then it will go slowly. Okay, in the fall also it will fall, but if ACGs fall, so therefore this is how a ratio chart will look like along with the price. So that gives you an idea how an outperformance can help.
Yeah.
It need to be measured and ranked, and but we are not going to watch charts in our sheet. We are going to watch only manipulate or use figures. So what is happening behind the figures is what I am trying to highlight over here. So that the issues, when you start using the sheet, all these issues which will not come into your mind, how it is made, why it is made, this is just to give you an orientation about it. So objective is to scale it between 0 to 100. Okay, there are various ways. I said to you that rate of change of RCS is what we are doing. Relative comparative strength is what we are doing. Stock divided by Nifty. That you can put in a rate of change formula, you can put in RSI formula and various things and actually create a figure for you. I said earlier, some people are comparing tops and judging it also. Okay, and we are doing in a running way, running 7 days. So every 7 days, new data gets in, old data goes out. This is what relative strength is that, and I have told you that we take the highest gain, and this is all we spoke about. Change, RSI, you can use all these things. Stock divided by sensor will give you an X value. Use that X into a rate of change and RSI to get ratings. Highest ROC or RSI are outperformers, lowest are underperformers. Now open interest. So we have said that we want the stocks which are in uptrend. Okay, fine, we got the stocks which are in uptrend. But we also want to know whether the stock was in strength or not. So we said we define strength and we want the stocks which are in higher relative strength. So trend and strength are the two shortlisting parameters we have spoken up till now. Then open interest. The open interest in futures market is essential, but alone open interest cannot do anything at all. Because open interest is only a net addition of position or reduction of position. So on standalone basis, open interest cannot tell you whether the prices will go up or down. So open interest is what if there are two people in the market. So for example, one buys and one sells. Transaction is 1. Trade is 1. Volume is 1. But open interest is 2. So it is a 2 is that both people are having open positions. Therefore, there is 2 open positions in the market. Market is of 4 people. So already 2 people have taken positions and the open interest is 2. Both are having open positions. Another person comes, he buys, and the one person who had earlier bought sells. Okay. In that case, open interest is only. Other way,
Hello.
third person. Hello. Yeah.
Hello.
Yeah. Hello. Yeah. You want to say?
Yeah. May you please repeat this open interest part once again?
Yeah. Okay.
Actually,
Yeah. Okay.
I got some problem and did not get it well.
Okay. Okay. Open interest is what? It is an outstanding position of the stock or market. If there are 2 people in the market, one buys and one sells. Transaction is 1. Trade is 1. Volume created is 1. But open interest will be 2. Because both people have bought and sold, one is bought and one is sold to each other, and both are having position. They will not square off a position. So open interest is outstanding position is 2. Third person comes, he buys. Out of that open interest, one person who is still in the market, he still wants to sell. So he has added one more position. And the new person who is coming to the market has bought. So open interest will become 4. One person is having two sell positions, one person is having one buy, another is having C. So A is having one buy, 2 is having, so B is having two sell, and C is having one buy. So what is the open interest position is 4. Now fourth person comes and he sells also, but A and B who are having buy, they sell the position to D, and D is having fresh position of 2. What happens? Open interest is 4 only, because the earlier two guys were squared off position A and B, and D has taken up 2 buy positions, and A had earlier 1 buy position, C had earlier had 1 buy position, taken up 2 position. Okay, so they square off. Ultimately what happens? Open interest remains same. So if outstanding position, if people keep buying and new positions are still being made, then open interest will keep going up. So open interest is just a net outstanding position of the market. It does not tell you whether you are going to go up. Hello? Hello?
Hello.
Hello? Yeah. Hello? Yeah.
Yeah.
Hello? Yeah. Hello? Hello?
Yeah. Can you hear me now?
Yeah, I can hear you. You can hear me?
Yeah. Yeah. Now I am getting it. Hello.
Okay, so yeah, I am able to listen. Hello? Hello?
Hello.
Yeah, I am able to hear.
Okay. Now I am getting.
Okay, so open interest is a net outstanding position of the market. It does not tell you the trend. It does not tell you the direction. So what happens is the trend is going to give us a sense of direction, whether trend is up or down. Strength will tell us whether the strength is gained or lost. And open interest will tell us the addition of position. So if market overall trend is up, then open interest is going up, then we can say that generally there is a buying pressure, because buyers are more dominant, therefore the prices are going up. So if prices are going up or down will give you an idea on a day-to-day basis whether the open interest addition or reduction. If there is a fall in price, then there is a addition in short position. If price goes up and open interest goes up, there is an addition of long position. If price goes up and open interest falls down, then there is an unwinding of position. That means squaring of position is happening comparatively. So open interest will only tell you whether the positions are unwinded or not. Volumes which are there are actually traded contract or actual traded prices between the transaction of a buy and sell. So if volumes are increasing, that means number of trades are increased. Number of trades are increasing, open interest is increasing, and the trend is up. So we know generally we can say it is a bullish picture. And vice versa. There will be one next snapshot which will be telling you about the combinations of open interest, which will give you more idea about it.
Okay.
Open interest does not give any clear indication about a new important role after volumes. It confirms the underlying position of the long and short position depending on the direction of the price movement. Now this table is a basic table guideline which will give you idea about what strategies to be based on open interest. All these things we are going to require when we are doing Excel sheet. Open interest. Okay, now these are columns we just trying to figure out in table format what is the open interest is rising. In the first row, open interest is rising.
Yeah.
Price is up. Okay, now we are saying price is up is against yesterday's, in comparison to yesterday's price. 1 day back.
Okay.
Okay, price is up over yesterday or below it. So price is above yesterday's prices. Now there is a trend, and we say that we will define a trend based on an average. The trend is up and the price is also up. Then we are saying volume is also increasing. So yesterday's volumes were higher than yesterday's volume. We are not taking overall volume, we are just comparing today's volume is compared to yesterday's volume. So the volume will increase yesterday or not. We are not looking at historical comparison of volumes. We are only comparing with today's volume against yesterday's volume. Now this is a candle movement. Now what is candle movement? Candle movement is every day there is an open high and close of the market. Now our stock. If closing prices are above the opening prices, closing prices are above the opening prices or the open close is greater than the open, then we say it is a positive candle. That means what was the quality of intraday movement generally on the previous day is noted over here. If the closing price is below the opening prices, then we say the quality of nature of movement on intraday was bearish yesterday or bullish yesterday, as the case may be. So price below the open is negative candle, price above the open is a positive candle broadly. Okay, so candle movement was positive. What is the implication of all this? Overall a bullish scenario. Implication is bullish and general strategy will be to buy.
Okay.
Okay. Now,
Okay.
so overall very volume where everything is supporting the buying. So next case is where rising. Price is up, trend is up, volume were decreasing. Volume reduced and there is a candle movement is negative. Overall, because trend and up movement, we give a benefit of doubt to still a positive build up. But there is some profit booking because candle movement became negative, volume decreased. Okay, therefore we take it as something roughly as a profit booking on long positions. Then open interest is rising, price movement is flat, trend is up. Now why we are giving in the earlier example positive buildup is purely based on rising, open interest is rising, price is up and trend is up. So these two enables us to put implication as positive buildup. If open interest in the second row which we are discussing, or even the volumes for that matter was increasing and this was negative, then we could have actually looked at as a hidden shorts or a contra sell, which we'll be doing in Excel sheet later. Right now it is not mentioned over here because that goes in slightly advanced thing, so we're not talking it right now. This is a basic guideline what a strategy one can follow. Open interest is rising, price is flat, there is no movement, it's almost same as yesterday's pricing. Then uptrend is there, volumes are decreasing, then there are indecisive dojis. What do you mean by indecisive dojis is, in Excel sheet you will not come to me about dojis because we are fixing open as simply price above the open is positive candle, price below the open is negative candle. But if you are watching some bit of charts and if there is an indecisive doji formation, indecisive doji means what? Market open at 100 rupees, went to 100, fell to 95, closed around 100. So market was volatile. It moved after opening, moved higher also, moved lower also. It can be other way around. Market opened at 100 rupees, fell to 90 rupees, recovered to close around 100. So any closings around the opening, with highs and lows significantly higher or lower, then it is like a tug of war. Buyers dominated some part of the day, sellers dominated some part of the day. results into a doji forming. And whenever such formation happens, there is a lot of difficulty on intraday. Purely because there are multiple, two swings are opening. Market opens, falls down and recovers and moves up, fine. Up to two swings in an intraday there is no problem. But if it is more than two swings, then there is, because what happens, none of the people who are taking buy position and sell positions are getting clear opportunities to enter and exit. Somebody who entered got stuck up, somebody who sold in short position got stuck up, because it swinged 3 to 4 times, oscillating around the open, the moving higher, moving lower, moving higher, moving lower. It is like a sideways, we spoke about sideways and multiple tops and bottom. The same scenario gets developed on index whenever such kind of formation is happening. So it is indecisive candlestick pattern. Market price movement was not decisive enough to take directional clue. It might be a halt to the fall, it might also be a halt to the rise. These things can happen. So if that is the case, keeping overall rising trend intact, overall positive, there is sideways movement, there is partial shorts created somewhere or the other downline, but broadly it will be profit booking. There is a hidden shorts created because market has gone up and down, open interest has increased, and it is going both sides. So both addition of long position, addition of short position, both has happened actually, leading to an indecisive pattern and lack of directional clue for subsequent day. Now, third is in the rising part, open interest is rising, then price is moved down, trend is down, volume increase, negative candle, bearish is sell. So falling, now open interest falling, price is moved up, trend is down, volumes increased, then there is a positive candle, short. It's a contrarian buy kind of a scenario. It's a short covering, contrarian buy, because open interest, short covering. And suppose in this scenario, if open interest was rising, now because it was falling open interest, we are mentioning short covering. Quick entry and trade can happen. If there was open interest, then we can say either the bottom is in place or there is new trend can emerge or a contract can emerge. Even there is a downtrend. That again will be taken up in the Excel sheet. I will show you how to sort it. Falling, price is up, trend is up, volumes are increasing, positive short covering buy. Because open interest is falling, this happens in the second half of the expiry. When open interest generally starts falling as expiry comes nearer and nearer. And this will happen when there is a shift of positions from 1 month to another. Okay, now people who are shorted earlier, they will try to either or bought earlier, they will try to book profit or sell. Those who are short, they will try to cover. So all in action in the next row. Open interest is falling, down, decreasing, indecisive candle, position unwinding, exit all position. Both people are buying and selling aggressively, prices are falling, open interest is falling, everything is falling, unwinding of position, no interest, lack of interest. This happens towards the expiry. In a contract period. The contract is about to expire, it will happen. So there is exiting of all positions. So falling down, in the last case, falling down, decreasing, negative position. When there is a sharp fall also, you can take unwinding of position. That depends on how smart you are and very quick and trader. So this is basic terminology and basic ideas about open interest, what will help us in when we are doing sorting. And then comes the levels. Levels will tell you buy if you get a better price. When we decide a particular buy or a sell, last closing prices is always the buy or sell price. If market is weaker and you get our lower levels, added advantage. never try to buy at higher levels. If before you might feel of left out might come because if the stock before you could buy is running away, then there is no choice, you may have to leave it. Every time it may not be beneficial. Sometimes you run and catch and it goes up further, you are benefited. Sometimes you run and catch and you get stuck up and price falls down, you are in trouble. Okay, so in order to avoid the second situation, we say that last closing price or our levels of buying like center point and level 2 are, which you see in the sheet, are the things if you are getting first then only do it, otherwise don't do it. If going out, let it go out because the risk will increase. The level are asking, so if a trade to be bullish, what are you looking at? Bullish trade strategy is to trade long, trade when there is an uptrend, trade with higher relative strength, and long trade where the volumes have to be rising, open interest has to be rising, candle movement has to be positive. This defines a basic criteria of shortlisting, like how to trade long. Bearish strategy, how to trade short or how to select short is
Hello.
the counter. Hello. 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 Hello.
Hello. Last few seconds I missed.
Okay. So now we are looking at a bearish strategy.
Last page.
Okay.
Last page.
Okay, we are looking at bullish strategy. In bullish strategy, what we said was that discuss up till now, the trend was up.
Up.
Long highest relative strength in a long trade, including open interest, including volume, candle movement has to be positive. So this is a basic criteria of selecting up positions and buy positions.
Okay.
And the bearish strategy, where we are looking at short trades, short trend down, relative strength has to be falling, increase in volume, increase in open interest, candle movement has to be negative.
Yeah. Okay, got it.
So this is as far as the basic trades are concerned. Now let me bring the Excel sheet for orientation purpose. Now this is how the Excel sheet will look like. Okay.
Okay.
Now in this scenario, over here you can see on the top where my mouse is there, we have two sheets. One is ascending, sorting down, sorting for up. Okay, now we just click on to descending, and this is where Nifty. Now what we are talking about, Nifty is on the top. Now why? Because I am looking at the relative strength column. First I will introduce you the columns. Now that's a security name. Then LC, last C is last closing price. Okay. Hello.
Hello.
Are you there?
Yeah.
Okay. LC is the last closing price. C reversal is the DRV or the moving average which you are talking about. If the price is above the DRV or the C reversal, then the trend is up. If price is below the DRV, then the trend is down. Okay, this is the trend.
Okay.
And the DRV is above this, so we are saying that there is an uptrend. Volumes. These are the volumes which are created yesterday after the end of the market. Okay, so this is actual volumes traded. Percentage V. It is comparing yesterday's
This
volume.
volume is the previous day's volume.
Yeah, we are, as I said, we didn't talk that we are only concerned with the previous day's volume.
Okay.
We are not looking at the overall historical volumes. Because we want to create relation for next day. We don't want to create relations for long. Every day to day there will be this kind of a file which will draw you relations on a day to day basis. Okay, this is not a one-time sheet. It is a dynamic sheet which will happen at the end of the day prices. basis. So therefore, there is 20 Excel sheets which we are talking about during the month kind of a thing. So every day we are only taking the yesterday's volumes and comparing it with 1 day back volumes. So that is percentage V. If it increase, then it will show plus 2. If the volume decrease, it will show minus 2, as it is showing over here. Okay?
Okay.
When there is a gain or loss, again we are checking the price up. In the discussion about open interest, we mentioned the price up. The price up against yesterday's closing, 1 day back closing. So whether it has gained or over the previous day's closing. Okay.
Okay.
When we are looking at previous intraday, PC and NC, then we will talk about positive candle and negative candle. So price above the opening, price, current price or last closing price above the open is considered as positive candle. Price below is considered as negative candle. Now candle is PC, negative candle is NC. In this row which is mentioned. Okay, so PC is 1 number, NC is 0 number. Okay. PC is 1 number, NC is 0 number. In this this tells me what is the quality of the movement on intraday previous day. Next is open interest. Open interest is again a 1 day back or yesterday's or today's. We are not comparing historical open interest again. So yesterday's open interest was so and so. 1 day back open interest was increased or decreased. That is checked over here. So it will be positive figure if it is increased, it will be minus figure if it is decreased.
Yeah.
Okay. Now signal. Fresh B or S. Fresh B means fresh buy signal. Fresh S means fresh sell signal. Now sell signal and buy signal will come when the price crosses the DRV or the reversal point which we spoke about here, where the mouse is there.
Yeah.
Like today, 5711, this is 14 file. One minute, let me pick up file of 16 only. Okay, I'm just picked up the file of 16. Okay, and we are taking it recently. So the 48 was the closing one yesterday.
Hello.
And the DRV is.
Hello.
Hello.
Hello. Hello.
Yeah, hello.
I missed. I missed this DRV part. From
Okay.
that DRV part.
You are not missed not much. I opened a new file. What I'm saying is that the trend part, the fresh buy and sell signal. Okay. The fresh B is buy and fresh S is sell. Okay.
Yeah.
Now we come over to the column. What do you mean by fresh buy? When the price crosses the DRV fresh, that if today my trend is up today our trend is up as of yesterday's market and the DRV is at 5653. If tomorrow market closes below 5653, then that will be considered as a fresh sell signal because price moved below the DRV. So there will be one number for fresh signal. Fresh signal buy or sell, B or S. B is for buy, S is for sell. Okay.
Yeah.
Okay. Now one number is associated with fresh signal. If any fresh signal is there, it will not know whether it is buy or sell. We have to look at trend. If the trend is up and there is one number over here, then we say that it is a buy signal. If trend is down and if it is one number, then we say it is a sell signal. So fresh B or fresh S is fresh buy or fresh sell signal. One number is associated with fresh signal.
Okay.
Okay. So up till now what we have done, we will do that sorting and then we'll proceed for advanced sorting. So let's check. Before going further, I'll just tell you one point. Levels we'll discuss later, it is not required now. We are talking about motion and strength. If you see in this RS we discussed up till now, relative strength, which will be called as RS, because
Yeah.
we are keeping benchmark. Hello?
Hello. Yeah.
Hello? Because we are keeping benchmark Nifty, Nifty will always be having 100 as a value. Okay? So Nifty is the
Okay.
benchmark. So we are always having Nifty at 100. And all are sorted this 87, 80, 85, 83. As we see, we can go down 78, 60. These all are sorted on the basis of relative strength. The entire sheet is sorted from descending order, from highest to lowest.
Yeah. In descending order.
So this is the column where it is there. So when we are looking at a market like this, it is a 10.9 which is showing the relative strength. Let's see what it is. We saw Indian Overseas Bank to be falling more, and it has been the weakest out of the lot as of yesterday's prices up till now. The sorting is on column R, which is relative strength. Okay.
Okay.
Hello. Okay. Now,
Hello.
right now we'll just do whatever we have done up till now. We'll do the sorting. Now, how to do the sorting? On top there are sorters. Sorters are given. Okay. I'm just flashing the sorter. Can you see? Hello.
Hello. Hello.
Can you see the sorters? Hello. Can you see the sorters? Can you see the mouse? Can you see the picture?
Hello.
Hello. Can you
Hello.
hear? I can hear you. Can you hear me?
Yeah. May you please stop for 5 minutes?
5 minutes.
Hello.
Okay.
May you please stop for 5 minutes? I am checking my internet connection. It's probably
I can hear
doing
your.
wrong something.
No. I can hear your voice. Voice is coming. The bandwidth might have just got little bit on the lower side. Nothing else. Otherwise, the voice will not come.
Please be patient. I will be back in 5 minutes.
Yeah.
I am I am going to turn off my internet and again going to turn it on.
Okay. Daddy करना है. Mama.